Now, for this week, I would like to talk about the U.S. inflation, which continue to soar, and how is it going to affect the U.S. dollar, and so on. We're going to deal with it. Okay, so first of all, the inflation in the US persisted on its upward trajectory, with the consumer price index increasing by 0.3% year over year to 3.5% in March. Core inflation, on the other hand, remains steady at 3.8% for the same period, slightly surpassing the forecast by 0.1%. Now, consequently, no significant improvement in inflation rates was observed. Okay, so it is no improvement if you were to compare it for February, even for January as well. Now, this development dampens the Federal Reserve's plan to reduce interest rates to stimulate the economy, right? It will be pivotal to monitor the Fed's response to this recent data. That's why Wednesday's meeting is crucial. I want to see what Jerome Powell would be saying. Now, although Fed Chair Jerome Powell previously dismissed earlier inflation spikes in January and February as temporary, it remains to be seen if he will apply the same rationale to the worse than expected March figures. It is not good. Okay, so given the rising inflation, the possibility of a Fed cutting rates now appears a bit more complex than before. Okay, and a quick look at this table right over here. This is the CME Fed Watch 2 meeting probabilities table. Following the inflation report, the likelihood of a rate cut in June has notably decreased, with current expectations of a rate hold at 71.7%. This number was pretty high in the past, and right now you have seen it dropping already. Okay, and it's holding at 71.7. So anticipation for the initial rate reduction has now shifted to July, unless we get very good data for April and May. And especially if we see inflation reducing significantly. If it stays the same, I wouldn't want to bet or even on a July hike. Okay. So anyway, for now, if you look at the July probability over here, it has a higher probability. It's leaning towards more of a rate hike in July. So we will have to see. Okay. Now, one thing's for sure, if inflation continues to escalate, even July may see postponements in rate cuts, potentially deferring any reductions to September, November, or December. These are the three remaining dates right over here. Okay, aligning with Fed's tentative plan for 3 rate cuts in 2024, if they still want to follow this plan. That's why it's crucial. Let's listen to Jerome Powell, what he has to say. If he still maintains that 3 rate cuts, these are the possible dates. And definitely you'll see rate cut here, here, and here, if Jerome Powell maintains that and they don't cut in July. Okay, so that is the expectations. Right. So if inflation declines in Europe and the rest of the leading economies, while US data remains unfavorable for rate cuts, the US dollar is likely to strengthen further. Okay. Additionally, the US stock markets might experience a temporary correction before potentially rebounding. I've mentioned in the past, high interest rates, prolonged interest rates, it is not good for the economy. Okay. So we will need to study this in detail. And most important thing that you need to know is that it's important to clarify that this refers to market. I've mentioned is market correction rather than a crash. Okay, because if you look at the overall data over here, the jobs, they are still strong. They are still strong. So so that can actually support the economy right at this current moment. So you just need to double check and see, but this cannot continue, because if you were to continue and jobs data is strong, then the companies would need to hire more workers, and then to attract these workers, they have to have higher wage wage hikes, right? Higher wages, and that if you look at the overall the remunerations of the workers, usually they represent a big chunk of the company expenses. And so if you were to increase that further, that will eat into the profits and that will reflect in the market. That's why I said that you might experience a temporary correction before rebounding rather than a crash, because overall data is still pointing to a resilient US market. Okay, so with that understanding, you know how to deal with it. If it continues, that we can continue to look for the buys in the US dollar. At the same time, if they were to maintain it, then we can look to short the US stock market temporarily. And I've mentioned in past reports, in years, the election years, the market do retrace. They retrace sometimes to 5% to 10%, and they can retrace do corrections about 3 times a year. Okay, so the current one that we're seeing, it still haven't hit 5%. If it does, then that's the first correction of the year, and then there's 2 more to come. Okay, so this is considered normal, so not to worry. Okay, so with that, that's the end of the fundamental report for today. Let's look at the chart.